Okay, we are going to run through some things about the stock market here with these next set of notes over economics. So, starting off with stock represents ownership in a corporation. When you buy stock, you're becoming a part owner in that corporation. Uh, Corporations issue stock in order to raise money. So, let's say that I start out a business. Let's say that it's a business which I am, I don't know, selling donuts. It's morning time. I got my coffee here, so I'm going to say I'm selling donuts. Okay. Uh, my donut shop does extremely well. Okay. Goes way, 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 way up. Brunswick Bismarck Donuts does very, very well. Selling donuts left and right. And I want to expand. When I want to expand, I could go to a bank and get a loan from the bank in order to expand, maybe to open up another franchise in a different city or a different part of the city, maybe to go to a different state, or maybe just to enlarge and buy a new space for my donut shop. Okay, Brunswick's Bismarck Bakery, Triple B. I don't know. I'm working on the name still. But if I wanted to, I could go to a bank, or I could decide that I wanted to go and offer other people an ownership stake in my company. So I own the company right now. Okay, I'm 100% owner. If I wanted other people to invest in my business, I could offer them stock. And then when they pay me and become part owners in my company, buying into my company by me giving them stock in my company and they're being part owner, I can take the money that they are paying to me and I can use it to expand. I can use it to go and buy that second shop or to buy maybe extra storage space or kitchen space or whatever. If you've ever watched the show Shark Tank, that's exactly what's happening on Shark Tank, is that people are taking their ideas, they're small businesses, and they want to expand them, and they're looking for someone to buy in, become part owners in their company with them. Now, so when you buy stock, it represents that you are a part owner in that company. Okay, so we don't really need to know this slide. If we were actually doing economics in class, we talked a little bit more about this. But basically, let's say that real brief, I'm the owner of the supply or of my donut shop, and I then go and get two more investors and say I keep 50% of the company for me and I give them each 25% in their stock. That's kind of what this is referring to, ownership percentage. Okay. Now, all right, a stock certificate. Next term here in your notes there, stock certificate. This is what actually represents that you are a stockholder, that you actually own part of the company. Most of the times today, you don't get an actual certificate. Most of the times today, it's electronically. Back in the day, we got a Ford Motor Company stock certificate here, Union Pacific stock certificate. So you would actually get from a stockbroker, when you bought the stock, an actual physical stock certificate that would show that you are part owner. Okay. So when you buy stock, and if we do the little stock market simulation game, this will be something that you will calculate for you, but something to keep in mind. So if I buy, like say that Facebook stock is $184.67, I think it's quite a bit lower than that right now because the whole market is lower. But if I were to buy, that's the cost for one share. If I were to buy 100 shares of that, it would then cost $18,467. Okay, I have to multiply the price per share times the number of shares that I purchased. Okay, so that's not in your notes, but just a little FYI there. So why do people buy stock? Well, two reasons. First of all, when you own stock in a company, oftentimes that company will pay what are called dividends. That means if the company does very well and makes a lot of money over the time period, and usually that time period is a quarter, business quarter, which means 3 months of a year. Every 3 months, you would get a portion of that company's profits. So if you have ownership in Nike and Nike does extremely well, you would get a dividend paid out to you as a stockholder. Okay, you get a nice little check in the mail, not because you did anything, just because the company is doing well and you are a stockholder in that company because you had bought into that company. The other reason that people buy stocks, and what you might do if we do the stock market challenge, is to make money off of the buying and selling in stock, what stockbrokers try to do. So this is where you buy a stock when it's at a lower price, and then you sell a stock when it's at a higher price. So let's say that you bought, say, Amazon back in whenever Amazon started, 1996, 95, somewhere around there when Amazon started. Maybe it was only like $40 for one share. You bought stock in Amazon. Now the stock is, thousands of dollars, if I remember correctly. I haven't checked it recently. But if you were to sell stock in Amazon today after buying it way back in 1995, then you would get what is called a capital gain. However, the opposite can happen as well. Let's say that you were to buy stock, back in February. Let's say you were to buy stock in Amazon. Odds are, if you were to sell that stock today, the stock market has gone down a lot with this coronavirus outbreak, and so you would experience what's called a capital loss, in which you bought the stock when it was at a high price, and then you sold it when it was at a low price. That means you lose a lot, or you lose money, and that's called a capital loss. So capital gain, earning money from the buying and selling of stock. Capital loss, losing money from the buying and selling of stock. Okay. Next things in your notes here. There's two different kinds of public stock that you can buy. If you're buying into Ford Motor Company or into Verizon or into Walmart, into Amazon, Target, two different kinds of stock. First of all is the common stock. Common stock is the kind that you and I can go out and buy. So when we talk about going online and like going to Vanguard or E-Trade or TD Ameritrade and buying stock, that's the stock that you or I can buy. Well, that you could buy once you get to be at the age 18 that you can actually open an account and buy stock. Because you can't do it as a sophomore in high school yet. Sorry about that. So this is called common stock. Preferred stock is stock that is most of the time only offered to people in the company. So like if it was Amazon stock, part of the perks of working for Amazon might be that you get to buy stock in the company. And sometimes it's a little bit more than common stock. It might be a little bit more expensive. Sometimes it might just be offered directly to the person free of charge. It just kind of depends. But with preferred stock, the one thing that is unique about that is that they get paid before the common stock owners. So if anything bad ever happened to the company, and say we had, say, like a Blockbuster video scenario where the company just goes out of business, preferred stock owners would get paid first, and common stock owners would get paid last. And so common stock owners might not get paid if the company is doing very, very poorly. They might not get that dividend if the company is doing poorly. Okay. The other kind of stock is unlisted or private stock. That means that it's still company owned or privately owned. It's not available for anybody to buy. That would be like Hy-Vee or Scheels. They have stock. If you work for Scheels, you work for Hy-Vee, you can buy stock in Hy-Vee or you can buy stock in Scheels because you're part of the company, you're an employee, but you can't actually do it. Like Mr. Brunswick, I can't buy stock in Scheels or I can't buy stock in Hy-Vee because I don't work for them. Okay, so then I have that as an example there, Hy-Vee and Scheels as an example of unlisted or private stock. Okay, moving on. Split stock, next term here. Some stocks get so expensive because they're such a successful company that the average person cannot purchase that stock. Berkshire Hathaway, this huge investing company here right out of Omaha with Warren Buffett at its head. If you were to buy stock in Berkshire Hathaway, it costs you about $299,000 to buy one single stock. Can't afford that, right? Most people can't afford that. So what Berkshire Hathaway did is they split up their stock share. They divided a single share of stock into more than one share. In Berkshire Hathaway's case, they created a B stock that's only 1/1500th of an A stock, so it's not a whole lot of stock. But you can buy that and you can still be a shareholder in Berkshire Hathaway, and it's a lot less. I'm not sure what the Berkshire Hathaway B stock is at. You'd have to, if you search Berkshire Hathaway B stock in your, open up a new tab and search that, you probably could find it, or you would be able to find it, and it's going to be a lot less than the Berkshire Hathaway A stock. Okay, so kind of to wrap this up here a little bit before we move on to a little bit something different with stock. The risks of buying stock. When you buy stock, it's not a guarantee. Firms and companies, they go through economic downturns. We're experiencing that right now with the coronavirus. If you've been following the stock market at all, stock prices have been going down. Companies' profits are going down, and so people aren't wanting to buy into their companies as much. If a company you invest in loses money, stock value decreases. That means less money for you. It could even mean that you lose all of your money if the investment goes extremely poorly. Think Blockbuster. When they went out of business, if you own stock in Blockbuster, you're kind of just out of luck with that money that you invested into Blockbuster. So there are definitely risks in buying stock. Okay. All right. So a little bit of terminology with how the nuts and bolts of buying stock works. So a stockbroker is someone who links buyers and sellers of stock. In the olden days, you'd have to go to a stockbroker in order to have them buy the stock for you. Ford, Union Pacific, think those old stock certificates I showed you. They'd be paid on commission. So, if the stock cost $20, you might have to pay an extra $5 to your stockbroker in order for them to actually go and buy the stock for you. Okay, and stockbrokers would get paid on the profits that they made off of the buying and selling of stock. Okay, another term here, brokerage firm. This is a business that specializes in trading stocks. This is where stockbrokers work. So you think about E-Trade, Vanguard, Scottrade, Edward Jones, TD Ameritrade. These are the big firms that they follow the stock market. They follow the trends and what businesses are doing well, what businesses are not doing well, maybe what's in short supply, and so the prices are higher, and so what goods are going to be in demand and what companies are going to be in demand. They follow all the ins and outs of what is going on with the economy. Not just the United States economy, but also the global economy. Okay? And this is also where, in modern day, you can, once you get to be of age, you can go to Edward Jones or Scottrade, Vanguard, E-Trade, and you can actually be your own stockbroker and go purchase stock online through them. And you don't have to necessarily go through a stockbroker. You can just go through one of those brokerage firm websites. Finally, a stock exchange is the actual physical place where stock is bought and or sold at. Okay? The most famous stock exchanges are the New York Stock Exchange, that is located in Manhattan, Wall Street. Okay, let me click here and go to a link real fast so you can get a picture where this is at. New York Stock Exchange. Okay, this is where some of the biggest and oldest companies and best companies in the United States are traded at. If I were to zoom out here, it's in Manhattan. Okay, Lower Manhattan of New York City. Okay, that's the actual physical place. Okay. Only trades the largest and most established companies that are traded on New York Stock Exchange. So, Mr. Brunswick's donut shop, whatever I end up naming it, the Brunswick Bismarck Bakery, probably not going to be traded on the New York Stock Exchange. Okay, the NASDAQ is another stock exchange, a physical place where stocks are traded at, and that also is in New York City. So if I pull this up here, again, it's going to be, you can see the World Trade Center there. It's going to be in Manhattan, Brooklyn Bridge. It's not too terribly far away from where the New York Stock Exchange was. Okay. Let's see, I got a link to some photos here. The NASDAQ mainly trades tech companies. Tech and energy stock is mostly traded at the NASDAQ. Okay, a couple of photos of the NASDAQ there. And actually, I wonder if I go back to New York Stock Exchange. Let's see, do they have other photos? There's a famous photo. If you've ever seen the photo of the bull, the phrase "a bull market" means that things are going really, really well. And so there's this bull that was posted up, or a big bull statue that's posted up near the on Wall Street near the New York Stock Exchange. And the flip of that is that a bear market, a bull market means the market's doing really well. A bear market means the market is not doing very well. Okay? So a couple other things here about the stock. So there's something called stock performance indexes that try to get a measure of how stocks are doing in America. There's what's called the Dow Jones Industrial Average, which averages the 30 of the largest companies traded on the New York Stock Exchange and NASDAQ, okay, and how well they have gone up or down. So when you hear the TV networks say the Dow is up or the market is up or the market is down, they're usually referring to the Dow Jones Industrial Average, those top 30 companies. If you open up a new tab and search Dow Jones Industrial Average or what companies make up the Dow Jones, you'll see that it's a lot of companies that you recognize: Caterpillar, Walmart. I know 3M was on there at one point. Apple. You'll find that a lot of the companies that are on there are companies that you would recognize. Another index is called the S&P 500. This just tracks the next 500 different stocks that are the biggest companies in the United States. And it generally gives a bigger and better representation of the U.S. market and how it's doing in terms of, if the S&P 500 is up and is doing well, that means that those 500 companies are doing well. And so the American economy, we could say, is probably doing okay. Or if they're not going down, or if those companies are not doing well, or the stock prices are down, the American economy is probably not doing as well. Finally, a couple of last terms here. Bonds. Bonds is debt from a company or from a government that a person can purchase, and then they receive repayment plus interest on them. The easiest way to think about this is U.S. savings bonds or U.S. war bonds. From history, you've probably heard of war bonds, or maybe you've even gotten a savings bond from your grandparents or parents. You can actually purchase U.S. debt. So when the American government goes into debt, it is put up for sale and you can buy it. And these are called treasury notes or treasury bills or T-bills or T-bonds. They come from the U.S. Treasury, and when you buy them, they will pay you back. So I'd say you bought a treasury bill for $50. They will pay you back that $50 plus interest over a period of time. It might be 5 years, it might be 2 years, it might be 10 years. Within the contract, it's set up that way. But when you buy those bonds, you can eventually make money. It's not a get-rich-quick scheme by any means, but it's a good long-term investment. And it's a safe investment, especially government bonds, because government hasn't gone under in the United States yet. It's a very safe investment. And if the U.S. government did go under, well, we'd have bigger problems to worry about than our treasury bonds. The final term here is a mutual fund. We've talked about this before in class. Mutual funds is what I would encourage you to invest in someday. This pools a bunch of stocks and bonds all together into one investment. So rather than just investing in one stock, so if I just invest in Amazon, hey, that's great right now because Amazon's doing well, but what happens if Amazon crashes? Well, with a mutual fund, it's not all invested in one stock. It's invested in different stocks, a bunch of different stocks. And so if one stock doesn't do well, you're still okay. Good example of this, Vanguard Energy Fund here. So if I scroll down in the portfolio of the Vanguard Energy Fund, you'll find that in this energy fund, there's BP, there's the Shell Corporation, there's Chevron, there's Marathon, there's Conoco, there's all these different energy companies. Okay? So that's going to do it for the notes. You can always email me if you have questions, if you're interested on these things. Please, just skim the surface here with the stock market, but hopefully you learned a few things about the stock market, about stocks, and how that whole thing works. Signing off.